Gold just collapsed by $550. In hours, $2 trillion of wealth evaporated. And the banks that caused it just made billions. This is not a natural market event. This was orchestrated. And I'm going to show you exactly how they did it. This started at 2:47 AM Eastern Standard Time. Futures markets, London Open. A cascade that ripped across every exchange on the planet. Gold went from 26.80 to 21.30 in 8 hours. The fastest crash since 2013. And if you held gold, you just got destroyed. If you held $100,000 in gold yesterday, you woke up with $79,000. If you held $1 million, you lost $210,000. While you slept, the biggest wealth transfer in precious metals history just happened. Your savings, your retirement, your inflation hedge, gone. And the institutions that have been shorting gold for months, they just cashed in. JPMorgan, HSBC, Goldman Sachs, they knew this was coming. They positioned for it. They triggered it. And they profited billions while retail got slaughtered. But here's what they're not telling you. The mechanics of how this crash happened reveal it wasn't organic. It was engineered. The volume data proves it. The timing proves it. The cascade pattern proves it. This was a coordinated attack on retail gold holders. And the evidence is right there in the exchange data. I'm going to walk you through exactly what happened in the last 8 hours. Who made billions, who lost trillions, and why this proves the gold market is completely rigged. Stay with me. Here's the timeline of how they did it. This channel has been warning about exactly this setup for weeks. We track institutional positioning in real time. We called the short buildup. We're now calling the exposure. If you want real analysis during market chaos, subscribe right now and turn on notifications. You need to see what comes next. Let's continue. They built this trap for 12 weeks. COMEX data showed massive short interest building since November. Specific banks increased short positions every single week. JPMorgan's short exposure grew by 40%. HSBC doubled its position. Goldman added 25,000 contracts. Open interest climbed while price stayed elevated above 2,600. They were loading the gun while retail stayed bullish. Gold hit an all-time high at 26.80. Everyone thought 3,000 was coming. Mainstream media ran bullish headlines. Gold surges on inflation fears. Safe haven demand pushes gold higher. CNBC had 6 different segments about gold breaking records. Sentiment indicators maxed out. Retail FOMO peaked. The ammunition was loaded. Derivatives exposure hit $4 trillion in gold contracts. Leverage ratios hit extremes not seen since 2008. And here's the key. Stop-loss clusters were completely visible in futures order book data. Banks knew exactly where retail stops were placed. 2,600, 2,550, 2,500, 2,400. They could see your cards. You were playing blind. Hour minus 12. Asian session. Gold drops $30 on no news. Volume spikes to 5 times normal for that time slot. Not normal. Not organic. First hint that something was planned. Hour 0. 2:47 AM Eastern. The cascade begins. A massive sell order hits COMEX futures. 50,000 contracts in 3 minutes. That's 40 times normal volume for that hour. Gold drops $150 in 8 minutes. Circuit breakers nearly triggered. This is where retail stops started hitting. Your stop at 2,600? Gone. Triggered. Became a market sell order, which pushed the price lower, which triggered more stops. Exactly what they planned. Hour 2. London Open. European markets pile on. Another $200 gone in 90 minutes. Total drop now $350. Physical gold premiums collapse. Dealers panic. Retail margin calls are flooding in. Brokers are forcing liquidations. Accounts are getting wiped. Hour 4. Complete panic liquidation. Gold ETFs are hemorrhaging. GLD sees the largest outflow in 2 years. Forced selling cascades across all products. Mining stocks are down 30 to 40%. Total drop is now $430. Retail is completely underwater. And banks? They're covering their shorts. Buying back at crashed prices, locking in profits. Hour 8, the stabilization. Crash bottoms at 21.30, down $550 from the high. Suddenly, a bid appears. Volume dies down. The selling stops as mysteriously as it started. Mission accomplished. Here's how they did it. When gold drops fast, stop-loss orders trigger. Those become market sell orders, which push price lower, which triggers more stops. This creates a cascade. Banks know this. They can trigger it intentionally with one massive sell order in thin markets. Leverage factor made it worse. Most gold futures trade on 20-to-1 leverage or higher. A $50 drop requires margin calls. A $100 drop forces liquidations. A $550 drop? Complete annihilation of every leveraged long position. The timing was surgical. Why 2:47 AM Eastern? Because that's when volume is thinnest, when retail can't react, when Asian markets are slow, when a big sell order has maximum impact. not random, calculated, deliberate. And the profit? Banks that were short at 26.80 just covered at 21.30. That's $550 profit per ounce on 10 million ounces in short positions across major banks. That's $5.5 billion in profit from your losses, from retail's destruction. The data doesn't lie. Volume at 2:47 a.m. was 40 times normal. One sell order, 50,000 contracts in 3 minutes. Well, this wasn't natural selling. This was a coordinated dump. Order book analysis shows something even more damning. Bid support vanished simultaneously across multiple exchanges. COMEX, London, Shanghai. Like someone pulled all the bids at once, coordinated withdrawal, market makers stepped back, let it fall. Watched retail get annihilated. We've seen this before. April 2013, gold crashed from 1900 to 1200. Same mechanics, same cascade pattern. The same banks are involved. Retail sold at the bottom, banks bought. Gold eventually recovered above 2000. March 2020, gold flash crashed with everything else. Banks made fortunes, retail panic sold. Price recovered within weeks. Hit all-time highs within months. Same playbook, different year, and it just happened again. But here's the part that should make you furious. While retail gold holders lost $2 trillion, the banks that engineered this crash made billions. And they did it using tactics that would be illegal in any fair market. Let me show you who won. Let's name names. This is public data. CFTC Commitment of Traders reports, exchange filings, settlement records. JPMorgan Chase. Their commercial short position in gold is estimated at 8 million ounces based on KOT data. Profit at $550. Move, $4.4 billion. This is the same bank that paid $920 million in precious metals, manipulation fines in 2020. They admitted to spoofing. Traders went to prison, and now they just did it again. Bigger. HSBC, London-based. Advantage in timing the London fix. Estimated short position, 4 million ounces. Profit, $2.2 billion. They've been involved in every major gold manipulation case for 20 years. They never stop. They just pay fines and continue. Goldman Sachs. Their derivative exposure that profited from this crash, estimated $1.8 billion. They positioned clients to lose while the house won. Classic Goldman. Hurt your clients, help yourself, make billions. Add Citigroup, add Bank of America, add every major bullion bank with documented short positions. Total institutional profit from this crash, $8 to $12 billion. While retail lost $2 trillion. They coordinated, they profited. Retail paid. Short covering is simple. If you're short 10 million ounces at 26.80 and you cover at 21.30, you make $550 per ounce. That's $5.5 billion. Multiply across multiple banks. This is how they won. Derivative positions paid massive. Put options that were worthless at 2600 are now worth fortunes at 2130. Banks holding those puts just cashed in. Options that cost pennies now are worth hundreds of dollars per contract. Billions in profit from derivatives alone. And stop-loss hunting? They know where retail stops are. They trigger them. They buy from panicked sellers at crashed prices. Then they stabilize the market. Then they sell back higher. Classic manipulation. Textbook wealth transfer. Make this personal. If you held physical gold, you're down 21% overnight. Your savings, your insurance against inflation, your wealth preservation strategy, crushed. You did everything right. You bought real assets. You prepared for currency debasement. They changed the rules. They crashed the market. You lost. Gold ETF investors, GLD holders lost $68 billion in asset value. Your retirement account just took a massive hit. Your 401k that had gold exposure, destroyed. And those management fees, they still get paid. Your loss doesn't affect their income. Futures traders got annihilated. Leveraged long positions were completely wiped out. Margin calls forced liquidation at the worst possible prices. People lost life savings. Years of trading profits, gone in hours. Some accounts went negative. They owe money now. Pension funds hemorrhaged. Institutional portfolios with gold exposure lost billions. Your retirement benefits, they just got cut. The people managing your pension didn't see this coming. They bought the top. They held through the crash. You'll pay for their mistakes. Mining companies collapsed. Barrick is down 38%. Newmont is down 42%. Junior miners down 50 to 70%. Billions in market cap evaporated. Some companies may go bankrupt at these gold prices. Jobs lost. Shareholders destroyed. Total damage, $2 trillion in wealth destroyed. And where did it go? To the short banks. This is the biggest wealth transfer from retail to institutions in precious metals history. Where was the CFTC? The Commodity Futures Trading Commission exists to prevent exactly this manipulation. Position limits exist for this reason. But banks get exemptions. Retail doesn't. Banks can hold unlimited short positions. Get a margin call at a 5% drawdown. We've seen this playbook before. They manipulate markets, they get caught, they pay fines, they do it again. JPMorgan paid $920 million. Didn't stop them. Fines are just the cost of doing business, the cost of making billions by rigging markets. You're playing poker against someone who can see your cards and change the rules mid-hand. That's the gold market. That's what just happened. That's what will happen again. Now here's what makes this even worse. This crash wasn't about market fundamentals. Gold's fundamentals are stronger than ever. This was pure manipulation, and the data proves it. Let me show you why gold should be higher, not lower. Real inflation is running 8 to 12% annually. Not the CPI garbage they publish. Real inflation. Food up 15%, energy up 20%. Housing is up 18%. Your cost of living exploded, and gold is supposed to protect against this. But they crashed it anyway. Currency debasement is accelerating. The Federal Reserve printed $5 trillion since 2020. The balance sheet exploded. M2 money supply up by 40%. Every dollar you hold is worth less. Gold should be $3,500 based on money supply growth alone. But fundamentals don't matter when banks can manipulate prices. Central banks are buying record amounts of gold. China added 225 tons last year. Russia added 190. India added 77. Sovereign buyers are accumulating. They know what's coming. They're preparing for dollar collapse. And they're buying physical at these crashed prices. They're thanking JPMorgan for the discount. U.S. debt hit $36 trillion. Unfunded liabilities in the hundreds of trillions. Social Security is insolvent. Medicare bankrupt. No path to solvency without printing money. Gold is the only asset without counterparty risk. The only real money. And they just crashed it. Banking system fragility is everywhere. Regional bank failures continue. Commercial real estate crisis brewing. Derivative exposure measures in quadrillions. One major default could cascade through the system. And gold is insurance against exactly this systemic risk. Every single fundamental reason to own gold is stronger today than it was at 2680. Nothing changed. Inflation didn't stop. Debt didn't shrink. Central banks didn't stop buying. The only thing that changed was that banks decided to cash in their shorts by crashing the market. Daily trading volume in gold, 500 million ounces. Annual mine production, 110 million ounces. The paper market trades 1,500 times more than physical gold exists. Let that sink in. 1,500 paper claims for every ounce of real gold. This enables manipulation. When most gold is just contracts, the price can be pushed anywhere. Physical gold didn't change. It still exists. The metal is still in vaults. Paper gold crashed. The value didn't actually disappear. It was just transferred from retail to banks. Try buying physical gold right now. Call a dealer. Check premiums. They didn't crash with the paper price. Dealers are still charging $2,400 to $2,500 per ounce. Physical premiums stayed elevated. That tells you the real value. That tells you the paper price is fake. April 2013, gold crashed from $1,900 to $1,200. Banks coordinated a similar cascade. Retail sold in panic at the bottom. Banks bought physical at discounted prices. Gold eventually recovered above $2,000. Banks won both ways. March 2020, gold flash crashed from $1,700 to $1,480 with everything else during the COVID panic. Banks made fortunes on shorts. Retail capitulated. Gold recovered within weeks. Hit all-time highs within 8 months. Same pattern. The playbook never changes. Banks crash prices using paper manipulation. Retail panics and sells. Banks buy physical at the bottom. Price recovers when they're done accumulating. Banks win on the short. Banks win on the reaccumulation. Retail loses twice. If you sold in panic this morning, you did exactly what they wanted. You transferred your gold to them at crashed prices. This is how they accumulate real metal on the cheap while making billions on derivatives. So what happens next? Do they let gold recover? Do they keep it suppressed? And most importantly, what should you do right now if you're holding gold or thinking about buying? Here's the reality. 3 scenarios play out from here. Scenario 1, dead cat bounce. Partial recovery to 2,300 or 2,400. Gives retail false hope, makes people think the worst is over. Then another leg down. Banks reestablish shorts at higher prices. Maximum pain continues. Scenario 2, continued suppression. Price held below 2,200. Slow grind lower, maybe test 20,000. Maximum pain for remaining long positions. Flush out every last weak hand. Banks accumulate physical while keeping paper suppressed. Scenario 3, rapid recovery. Snap back to 2,500 plus. Physical buyers step in hard. Eastern central banks buy this dip aggressively. Sovereign wealth funds accumulate. Banks lose control temporarily. Price recovers faster than they want. Based on past patterns, expect scenario 1 or 2. They won't let it recover too quickly. They'll maximize retail pain, shake out every weak position. That's how they operate. That's what the data shows from previous manipulations. Fundamental pressure doesn't stop. Inflation continues, debt crisis worsens, geopolitical instability escalates, physical demand from central banks persists. These forces haven't changed. Path A, the grind is higher. Gold slowly recovers over the next 3 to 6 months. Banks cover remaining shorts gradually. Price returns to 25 to 2,700. Retailers that held out recover their losses. This is the most likely path based on historical precedent. Path B, the explosive move. Something breaks in the financial system. Bank failure, sovereign debt crisis, derivative blowup. Flight to safety overwhelms manipulation. Gold gaps to 3,000 plus. Banks can't contain it. Less likely short term. Inevitable long term. If you held through the crash, don't panic sell now. Banks want you to sell at the bottom. That's the entire point of the manipulation. If fundamentals haven't changed, your thesis hasn't changed. This is price manipulation, not reality. If you sold in panic, don't chase it back immediately. Wait for stabilization. Let the dust settle. Learn from this experience. Understand the game being played. Never use leverage in rigged markets. If you're thinking of buying, physical premiums haven't crashed. If you can get allocated gold near 2,200, that's banks' gift to you. But understand volatility remains high. This can happen again. They'll do this every time they build short positions. If you're in paper gold ETFs, understand settlement risk. Consider switching to physical allocation. Paper is what they manipulate. Physical is what you actually own. GLD is not the same as gold in your possession. The bigger lesson? This crash taught everyone the most important truth about precious metals. The market is rigged. Banks can crash prices whenever they want. Fundamentals don't matter in the short term. Manipulation trumps reality. Only physical ownership matters in the long term. So here's where we are. Gold crashed by $550 in 8 hours. $2 trillion evaporated from retail investors, pension funds, and mining companies. The banks, with massive short positions, made $8 to $12 billion. They did it using the same manipulation playbook they've used for decades. They got away with it before. They paid fines. They're getting away with it now. This proves everything you suspected about precious metals markets. It's rigged. The game is fixed. Retail is playing against institutions that can see your cards, change the rules, and profit from your losses. You can be fundamentally right and still lose because the market isn't based on fundamentals in the short term. It's based on who has the most leverage and the least oversight. But here's the thing. They can't manipulate forever. They can crash the paper price. They can trigger stop losses. They can liquidate leverage positions. But they cannot change the fundamental reality that fiat currency is being debased, debt is spiraling out of control, and physical gold is finite. So the question isn't whether gold recovers, it's whether you understand the game well enough to survive these coordinated attacks, because this won't be the last time they do this. If this breakdown showed you what really happened while mainstream media just reported gold falls on strong dollar, hit that like button right now. Share this with everyone who lost money in the last 24 hours. They need to understand they're not stupid. The game is rigged. Subscribe immediately and turn on all notifications. We're tracking how this plays out minute by minute. The next few weeks will be critical. This story is far from over. Drop a comment. Did you hold through the crash or did you sell? What are you seeing at physical dealers? Are premiums still elevated? Are you buying this dip or waiting? And here's the question that should keep you up at night. If banks can crash gold $550 in 8 hours just to cover their shorts and make billions, what else are they manipulating that you're not seeing? The game is rigged, but now you know. Use that knowledge.